We are witnessing the unfolding of a full-scale financial and economic crisis within Russia, a systemic catastrophe that is the direct, inevitable consequence of an unsustainable war. The idea that Russia is a stable petrostate capable of fighting indefinitely is a dangerous illusion. The evidence, drawn directly from the statements of Russian economists and official financial data, points to a state that is rapidly running out of cash and is now resorting to desperate, self-destructive measures to survive. This is FPV Explainer, where we break down the most fascinating stories in drone warfare. If you're enjoying this deep dive, hit the like button, subscribe, and drop a comment telling us what topic you want to see next. Your feedback shapes our future videos and keeps us bringing you clear, detailed analysis from the front lines. The first and most alarming sign is the structural failure of the Russian budget. The nation is operating with a record-breaking federal deficit that the leadership is incapable of resolving. Despite desperate attempts to close the gap through increased borrowing, the system is fundamentally broken. This financial hole is not just a bookkeeping error, it is the physical manifestation of a military spending regime that consumes everything and produces nothing for the civilian economy. The cost of running the war machine is now exceeding all available revenue streams, leaving the government in a state of continuous financial panic. This financial hole is creating the perfect inflationary storm. The latest official data confirms that inflation has surged back to alarmingly high rates, driven by the massive injection of money into the system and the crippling shortages in key sectors. The weekly inflation rate, which has now been above the critical 0.2% mark for 2 consecutive weeks, proves that the state has lost control over price stability. This is not temporary volatility. It is a persistent, malignant trend that is accelerating. The price increases are not isolated. They are broad-based, affecting staples like food and, most critically, fuel. This desperation has led to the only available, yet deeply damaging political solution: an aggressive tax on the population. The government is preparing for massive tax hikes on businesses and an increase in consumption taxes to plug a financial hole that is unmanageable. This move, which is designed to raise taxes on small businesses and increase the VAT, proves that the leadership has lost control of the economy. They are forced to admit that they cannot simply print money, a move that would trigger uncontrollable hyperinflation, so they are choosing the secondary path of financial destruction, actively strangling the civilian sector through higher taxes. This is a cruel paradox. The state is paying for the war by making its own citizens poorer, a direct, visible transfer of wealth from the populace to the military budget. This move has been described by Russian economists themselves as criminal for business. The tax increases will not only burden large corporations, but will cascade down the supply chain, inflating the final consumer cost by far more than the official tax percentage. The burden of funding the deficit is being placed squarely on the shoulders of the average citizen, guaranteeing further social distress. The time for economic stabilization is over, and the financial shockwave is now threatening the entire structure of the Russian state.
We have identified the core financial instability, the crisis of inflation, and the budget deficit. But the most politically damaging and strategically significant symptom of this economic rot is the catastrophic fuel collapse. This is not a simple supply chain disruption. It is the deliberate, self-inflicted agony of a market that has been crippled by the war and is now collapsing under a combined assault of military strikes and government mismanagement. The evidence of this collapse is now unavoidable for every citizen in Russia. The price of gasoline on the retail market has climbed relentlessly, surpassing 10% growth since the beginning of the year, a rate that dwarfs the already high official inflation figures. But the price is only the secondary problem. The primary issue is physical scarcity. This scarcity is the direct, calculated result of Ukraine's kinetic sanctions campaign. Precision drone strikes have systematically targeted the most vital assets of the Russian oil industry, crippling key refineries and distribution hubs. This has resulted in the loss of between 8 and 14% of total processing capacity, a monumental and unsustainable blow to the nation's energy independence. The market is now suffering from a catastrophic physical deficit that is manifesting in a chaotic breakdown of the distribution system. This is where the government's attempt to manage the crisis has only amplified the disaster. The market has fractured, with a clear distinction emerging between large, state-aligned oil majors and the independent networks. The independent gas stations, which often serve remote areas and account for a significant portion of the retail market, are being systematically starved of supply. These operators are being forced to close their pumps because they simply cannot secure fuel. The reason is twofold: uncontrolled price growth and supply obstruction. The central bank's failure to contain inflation means wholesale prices are skyrocketing. Independent operators cannot purchase fuel at those high wholesale prices and still sell at a competitive retail rate, leading to massive losses and forced closure. More damningly, the industry is engaging in systemic market abuse. While the largest state-aligned oil companies are obligated to sell a portion of their fuel on the stock exchange to the independent sector, they are effectively sabotaging the deliveries. They prioritize funneling their limited supply to their own branded stations, leaving independent operators without product. This is a deliberate, cynical move that is driving thousands of small businesses into bankruptcy and concentrating power in the hands of the state-aligned energy giants. The consequence is a vicious spiral of decline. Strikes reduce physical supply. Scarcity drives up wholesale prices. Large majors hoard the supply for their own branded stations. Independent operators fail due to financial losses and lack of product. Chaos spreads as vast geographical areas lose access to fuel, despite government claims of stability. The most profound danger is that this crisis is not remaining local. The fuel shortage is a visible daily humiliation for the state, confirming that the war is coming home. Furthermore, the lack of supply is a direct threat to the military's small-scale logistics, which rely heavily on commercial-grade gasoline for drone generators and forward-area transport. This economic agony is the inescapable, brutal evidence that the financial resources of the Russian state are finite, and that the strategic decision to wage war is resulting in a fundamental, systemic failure of its most vital industrial sector. The agony of the market is the clearest sign that the current trajectory is unsustainable.
We have analyzed the systemic crises of inflation and banking instability. Now, we must confront the terminal threat, the unprecedented fiscal shock facing the Russian budget in the final months of the year, a financial maneuver that is guaranteed to accelerate inflation and solidify the nation's debt burden. This is the moment the state's failure to finance the war openly collides with its political commitment to continue spending. The core of this impending crisis is the government's desperate need to fulfill its astronomical front-loaded spending commitments for the military. The High Command and the Ministry of Finance have structured the budget so that a colossal 12 trillion rubles must be spent in the final quarter alone, October to December. This represents a massive, system-shocking expenditure of approximately 4 trillion rubles per month. An immense injection of cash into an economy that is already overheating and shrinking. This is not sustainable spending. It is a suicidal inflationary impulse designed to keep the war machine funded, regardless of the consequences for the civilian population. This massive, sudden influx of cash guarantees a new, intense wave of inflation, directly undermining the central bank's credibility and its ongoing battle for price stability. This deliberate inflation is compounded by the rising cost of national debt, a problem that exposes the futility of the state's borrowing strategy. Yields on government bonds, OFZ, have soared past 15%. At this crippling rate, the government's efforts to raise money through the debt market are rendered effectively meaningless. The cost of servicing the newly issued debt, the interest payments required to attract investors, is nearly equal to the total principal amount of cash being raised. This means that the state is forced into a zero-sum game, exchanging debt for debt with no net gain to finance the budget deficit. Putin's ability to borrow in a crisis is gone. The market is telling the Kremlin that its financial risk is too high. The final element of this fiscal failure is the immediate, direct impact on the population through aggressive taxation. To compensate for the deficit, the government is proceeding with deeply unpopular tax hikes, which will have a devastating cascading effect on consumer prices. The planned increase in the value-added tax, VAT, is a political admission that the government has no choice but to extract more money from its citizens. This tax increase is not just a nominal 2% jump. Financial models predict that it will trigger a chain reaction across all contractors and logistics providers, leading to price increases of 5 to 15% on popular consumer goods sold via marketplaces and retail networks. This ensures that every citizen will pay a higher hidden tax for the war. The convergence of these factors, the zero-gain debt cycle, the uncontrolled spending impulse, and the tax-driven price hikes creates a systemic breakdown. The state is accelerating its own economic ruin in a desperate attempt to sustain a war it cannot afford. The financial dead end is now a certainty, and the only remaining question is how long the political system can withstand the inevitable social and economic shockwave.
We have analyzed the failures of the financial center. Now, we confront the stark evidence that this fiscal strain is being brutally downloaded onto the regions, exposing a complete breakdown of governance and accelerating the crisis of military manpower. The Kremlin is not just failing to finance the war, it is actively forcing the regions to cannibalize their own limited resources to sustain a failing central state. The core issue is a deliberate shift of the financial burden. The regions, already operating on austerity, are receiving reduced federal support in the face of unrealistic, military-focused central budgets. The only financial tool left to regional governors is self-destruction. We are witnessing an immediate and desperate wave of local tax hikes, such as increases in the transport tax, to cover deficits. This creates profound public discontent and further erodes the legitimacy of local governments. This financial desperation is directly impacting the army's most critical resource, its manpower. In a clear and synchronized political action, major, wealthy regions like St. Petersburg and Tatarstan have been compelled to drastically cut the one-time payments offered to new military contract recruits. This move is not a coincidence. It is a direct result of the systemic lack of funds. The state is tacitly admitting that it can no longer afford the astronomical costs of the volunteer system. This synchronicity across key regions, which occurred immediately after the new deficit-ridden federal budget was announced, proves that the central government has issued a clear directive. You are on your own. Cut the costs. This regional financial strain intersects lethally with the manpower crisis. The Russian economy is facing a structural contradiction: a chronic shortage of labor in essential, base industries versus a sudden increase in unemployment elsewhere. Official reports attempt to paint an optimistic picture of the labor market, suggesting the deficit is softening. However, this is a dangerous deception. The true reason for the apparent softening is that companies are simply cutting their losses. They are reducing hiring plans and eliminating vacant positions as the economic downturn and high interest rates force them to contract. Meanwhile, the vital sectors that keep the nation functioning, Agriculture, logistics, transportation, and communal services remain in a state of terminal crisis. These industries, which rely on a constant flow of non-specialized labor, are the very same sectors that were stripped bare by the initial waves of mobilization. These sectors suffer from massive staff deficits. This means that the pool of physically capable men required for any new mobilization is now functionally non-existent in the civilian economy. Any further compulsory draft would be economically ruinous, instantly collapsing essential services like transportation and utilities that are already operating at capacity.
We have meticulously analyzed the collapse of key domestic sectors, but the final, unavoidable verdict on the Russian economy is delivered by the international markets. The crisis is not merely internal. It is a global phenomenon where the forces of finance and geopolitics are converging to create an inescapable squeeze on the Kremlin's budget. Russia's strategic and financial isolation is deepening, rendering its war effort fundamentally unsustainable. The first profound sign of this deepening isolation is the failure of the pivot to the east, the panda dead end. The Russian leadership, having been expelled from Western financial markets, desperately sought new sources of capital in China. However, this strategy has been met with a cold, hard dose of reality. Chinese banks and major financial institutions, the very underwriters needed to organize Russian bond issues, are systematically refusing to work with Russian entities. This paralyzing fear stems from the risk of secondary sanctions and a desire not to jeopardize their far more critical access to the US and European financial systems. The result is that Russia remains financially locked out of the global capital markets. The dream of financing the war through the vast Chinese capital pool is dead, leaving the Kremlin with no viable external option to cover its colossal budget deficit. This financial suffocation is amplified by adverse developments in the global energy market. The nation's primary revenue stream is under intense pressure. The price of Brent crude is trending downward towards $60 per barrel, driven by analysis from the International Energy Agency, IEA, projecting a significant global supply surplus. This means that even without factoring in sanctions or price caps, the natural forces of the market are reducing the Kremlin's profits. This pressure ensures that the already diminished revenues from oil and gas, the lifeblood of the military budget, will continue to contract, making the financial hole in the state budget deeper and more unmanageable. This economic reality is an external force that no amount of domestic propaganda can counter. This global financial squeeze directly intersects with the domestic crisis of monetary policy, creating an environment of paralyzing uncertainty. The central bank is facing an acute dilemma ahead of its crucial rate decision. The logical expectation is that the bank cannot afford to lower the key interest rate, which currently stands at a high level. Analysts widely anticipate that the rate will not be reduced, and there is a growing serious risk that the central bank may be compelled to raise the rate further to combat surging, budget-driven inflation. The high rate is necessary to fight inflation, but it simultaneously stifles economic activity and increases the cost of servicing the state's crippling domestic debt. The most telling sign of this financial anxiety is the immediate reaction of commercial banks. They are already signaling their distrust of the central bank's ability to maintain stability by aggressively raising interest rates on new deposits. This behavior is a direct, market-driven confession that they anticipate higher inflation and continued monetary pressure. This financial instability, which is compounding the crisis of confidence among the general populace, is the final element that proves the war is fundamentally unsustainable.
The combined effect of financial isolation, falling energy revenues, and domestic monetary paralysis guarantees that the economic base required to prosecute the war is rapidly dissolving.